Welcome to the Deep Dive. Our mission today, well, it's pretty crucial for anyone managing their own investments. We're really getting into the mind of Peter Lynch.
Yeah, not just a summary. We're aiming to pull out the blueprint he built, running the Fidelity Magellan Fund.
Exactly. Focusing on those core ideas and the practical steps he said any regular investor can actually use.
And maybe even beat the pros with, right? That was his big claim.
That's the core of it.
Right.
And his ideas, they really hold up, don't they? Doesn't matter if the market's sky high or, dropping like a rock.
Right. His focus was always the company, not the noise, not the latest panic about interest rates, whatever. It's about finding good businesses.
So our job today is to really unpack the source material, synthesize it, and basically hand you that toolkit.
Let's do it.
Okay, so where do we start? It has to be the track record. I mean, this is what put Lynch on the investing map, right? His time at Fidelity Magellan, starting back in '77.
Oh, absolutely. It wasn't just good. It was, well, it changed everything for mutual funds back then. He ran Magellan from 1977 to 1990.
13 years. 13 years. And over that time, his average annual return was, get this, 29.2%. 29.2% average annually.
Yeah, it's just staggering. To put that in perspective, he basically doubled what the S&P 500 did year after year.
So if you put $1,000 with him in '77,
by 1990, that $1,000 would have turned into over $28,000. That's the power of compounding at that kind of rate. Just incredible.
And it wasn't like he was managing a tiny pot of money either. That's what gets me. The scale became enormous.
Totally. The assets under management, the AUM, it started small, around $18 million in '77. Pretty modest.
Right.
But by the time he left, $14 billion.
$14 billion.
Think about that. Trying to find enough good ideas to invest $14 billion and still get returns like that, it's a huge challenge. Magellan became the biggest equity fund in the world and the best performing over that stretch.
Which makes his next move even more fascinating. He quits. 1990.
Yeah.
Right at the absolute peak, age 46.
Yeah, I mean, who does that? It totally goes against the usual story of ambition, especially in finance.
Why did he do it?
It was deeply personal. He talked about how his own father died at 46, and he just felt this pull, to spend more time with his family, his wife, and 3 daughters.
You mentioned the workload, right? Saturday.
After Saturday, 7:00 a.m. sharp, he was in the office. That kind of schedule just crowds everything else out. So the sources really stress it wasn't burnout or failure. It was perspective. He chose family.
Still, imagine the discipline. Turning down what must have been huge offers to start new things.
Oh, the offers were insane. He said later he turned down chances to launch these closed-end funds that would have pulled in billions instantly. Billions.
And he estimated.
Yeah.
What could they have grown to?
He figured even if he just got average market returns after 1990, those funds could have easily hit $60 billion, maybe more, given how the market went.
But he walked away from that.
He did. Stayed on as vice chairman at Fidelity, kind of mentoring younger analysts, passing on the knowledge instead of chasing more billions for himself. It's a powerful lesson, knowing when enough is enough.
And his path into finance wasn't typical either. No fancy finance degree at first. It started on a golf course.
Yeah, caddying. That's where he got what he called his edge. He got a summer job at Fidelity back in '66. He was 21 because he'd caddied for the president, Mr. Sullivan.
And that job changed things for him.
Big time. He grew up hearing all the scary stories about the Depression, the stock market just being a place to lose your shirt. Very risk-averse background.
But caddying, he's hearing these successful guys talk.
Exactly. CEOs, company presidents, just chatting about stocks they own, companies they liked. He realized these weren't wild gamblers. They were smart people making money in the market.
So he started looking them up.
Looked up the stocks they mentioned, saw they'd gone up, and it clicked. The market wasn't just a trap. It could build wealth if you actually understood the business behind the stock ticker.
And his education wasn't finance. It was liberal arts, metaphysics, logic. How does that translate?
While he always distrusted those purely quantitative academic models, he thought investing was more art than science, understanding stories, people, patterns.
Not just equations.
Right. He felt his logic studies helped him build a solid case for an investment, spot flaws in a company's story, think more broadly. He used to joke that the finance professors teaching the fancy theories weren't doing nearly as well as the analysts focusing on actual companies.
Common sense over complex math.
Pretty much. Observation, history, understanding the narrative. That was his approach.
Okay, that background really sets up part 2 nicely. Lynch's absolute #1 rule, know what you own. This is fundamental.
It's the bedrock, really, his big phrase. Behind every stock is a company. Find out what it's doing. Simple, but powerful.
And his key insight was that the average person, the consumer, actually has an advantage here, an edge.
A huge edge. Because you, the listener, you encounter products and services constantly. You see what's working, what people are lining up for, often way before some Wall Street analyst buried in spreadsheets does.
You love those 10-bagger examples, stocks that go up 10 times that people could spot early on.
Yeah, think about Dunkin' Donuts back in the day.
Yep.
Or Legs, Pantyhose, Taco Bell. These were everywhere.
You saw them succeeding.
If you lived near a busy Dunkin' or worked in a store selling tons of Legs, you knew that company was onto something. Wall Street often only jumps in when the big growth is already happening, or maybe even slowing down. The individual sees it starting. That's the edge.
So, okay, I think I've found one, maybe a new restaurant chain I love. How do I know if it passes the Lynch test?
He had this great little test, the Know What You Own test. Can you explain why you own the stock to an 11-year-old in like a minute?
Not the jargon, the story.
Exactly. Not the PE ratio or the beta. The story. They make this great thing everyone wants, they don't have much debt, and they're opening new stores like crazy. If you can't boil it down to that simple, clear story...
Then maybe just buy an index fund instead.
That's what he'd say, buy a fund. And he really stressed writing down that story before you buy the stock.
Why write it down?
Helps you clarify your thinking, makes you commit to the reasons you bought it. So later, when the stock price inevitably dips, you look at your notes, not your panicked gut feeling. Has the story changed? If not, maybe you hold on or even buy more.
And the sources make a great point today. Doing that research is easier than ever. No excuses.
Oh, zero excuses. Lynch used to talk about having to call companies for reports, wait for the mail, go to libraries for filings. Now
it's all online. Presentations, reports, competitor info.
A few clicks away. The amount of information is just incredible. So yeah, no excuse not to understand the company you're putting your money into.
Okay, let's talk about the big distraction. The thing that scares most investors off. The economy, market forecasts, all that macro stuff. Lynch was pretty dismissive.
Famously dismissive. His quote is legendary. If you spend more than 13 minutes analyzing economic and market forecasts, you've wasted 10 minutes.
Okay, blunt enough. Why so down on it?
Because it's basically guessing, trying to predict the unknowable future. He loved to point out that economists had predicted something like 33 of the last 11 recessions.
Right. Their track record isn't exactly stellar.
Even the head of the Federal Reserve can't reliably tell you where interest rates will be next year. So why should you base your decisions on what some pundit thinks might happen? The market and the economy aren't the same thing.
So ignore the headlines about inflation fears or potential recessions.
Ignore the predictions. Focus on facts you know now. What's the company's debt load today? What are used car prices doing now? What's happening with housing now? Those are things you can actually analyze.
But the long-term stock price?
Driven by one thing, ultimately. Corporate earnings. How much money is the company actually making? That's what matters over time. Not politics, not short-term crises. If you own a great company that keeps growing its profits, Lynch argued, the stock price will eventually follow, regardless of the macro noise.
Which leads straight into handling volatility. The market swings are brutal. Lynch saw plenty of downturns.
10 major ones while he ran Magellan. And he pointed out his fund often went down more than the market during those dips.
So how do you prepare people for that? It feels awful when your stocks drop.
You have to accept it. Volatility is just the price you pay for potentially higher returns in stocks. He said the average stock on the NYSE swings 100% between its high and low every single year.
100% swing.
Yeah. So most stocks you buy are probably going to go down at some point after you buy them. You just have to steel yourself for that.
The real danger isn't the drop itself, it's how you react to it.
Precisely. Panic is the killer. Lynch had another great line. Far more money has been lost by investors preparing for corrections than has been lost in the corrections themselves.
People selling good companies out of fear.
Exactly. Selling low, waiting for the crash, then maybe being too scared to get back in. The key is your stomach, your temperament. If it's money you absolutely need in a year or two, like for tuition...
Don't put it in stocks.
Right. But if you have a long time frame, 5, 10, 20 years, you need the guts to see a drop in a good company, not as a disaster, but as a sale. Lynch called it a 5-for-4 sale. an opportunity.
Okay, so we need the right mindset. Now let's get practical. How did Lynch organize his thinking about which stocks to buy and when to sell? He had this famous framework.
The 6 categories. This is so useful because it acknowledges that not all stocks are the same. You can't use the same strategy or, crucially, the same selling rule for every company.
Different stocks, different game plans.
Yeah, totally. You need to know what kind of story you're buying into.
All right, let's break them down. Category 1, slow growers.
1. Slow growers. Think giant established companies, utilities, maybe some big consumer staples. They're growing, but slowly, maybe just 2-4% a year, kind of like the overall economy.
Not going to make you rich quick.
No, you buy these mainly for the dividend. They pay out regular income, provide some stability. The sell rule is pretty straightforward. Sell if the business starts to genuinely struggle, or the big red flag if they cut or threaten the dividend. That's your signal the stability is gone.
Okay, next up, the stalwarts. Still big, but growing a bit faster.
Stalwarts. Yep. These are your large, well-known companies. Think Coca-Cola, Procter & Gamble, maybe Johnson & Johnson, growing maybe 10-12% a year. Solid, reliable performers.
What's their role in a portfolio?
They're good protection in a recession. People still buy Coke and toothpaste when times get tough. They tend to hold up better.
And when do you sell stalwarts?
Lynch suggested looking for maybe a 30-50% gain, but more importantly, watch the valuation. If the PE ratio gets way too high compared to its history or its growth rate, it might be time to trim or sell. They get overpriced. Then you wait for a market dip to maybe buy them back cheaper.
Got it. Now for the exciting stuff. Fast growers. Home of the 10-baggers.
3. Fast growers. Right, these are smaller, often younger companies, really kicking into high gear. Growing earnings 20-25% a year, maybe more. This is where you can get those massive returns, 10x, 20x, even 100x your money.
High risk, high reward, though.
Absolutely. Huge potential, but also huge risk if they stumble. The key research here is digging into the balance sheet. They must have low debt, ideally no debt, because fast growth often eats up cash.
And you have to figure out when the rapid growth might end.
That's the million-dollar question. Are they running out of new places to expand? Is serious competition showing up? Has the market for their product gotten saturated? When the growth inevitably slows, or if the stock price gets totally crazy high, you got to be ready to take profits.
Okay, category 4 requires real expertise. Cyclicals. The timing sounds tricky here.
Cyclicals, yeah, these are tough. Think airlines, cars, steel, chemicals, housing. Their profits swing wildly up and down with the overall economy.
Boom and bust.
Exactly. And this is where amateurs get killed, because they usually buy when business is booming and the stock looks great.
Which is exactly the wrong time.
According to Lynch, yes. He said you buy cyclicals when things look absolutely terrible. When earnings are awful, the industry's depressed, nobody wants the stock.
That takes serious nerve. Buying when everyone else is selling or avoiding.
It does, because if you wait until the headlines are positive and earnings look fantastic, you've probably missed the big move up, that moment when earnings go from great to spectacular. That's often the peak, the time to sell, not buy.
So you need deep industry knowledge.
You really do. You need to understand inventory levels, pricing trends within that specific industry, and check the balance sheet carefully. Low debt is critical for survival during the inevitable downturns.
Okay, 5th category. The comeback kids, or maybe not. Turnarounds.
Turnarounds. These are companies that have been beaten down, maybe near bankruptcy. Think Chrysler back in the day. They're hated, they're risky.
High risk, high potential reward again.
Definitely. If they actually pull it off, the returns can be huge. But many don't. So homework isn't about growth prospects. It's about survival. Check cash, check debt. Can they make it?
People often buy these on hope, right? A new CEO, a new plan.
Yeah, but Lynch warned against that. Don't buy on hope. Wait for actual evidence of the turnaround happening.
What does that look like?
Tangible stuff. Losses getting smaller, like going from losing $6 a share to losing $2 a share, selling off divisions to raise cash, restructuring debt, seeing proof the bleeding has stopped, or at least slowed dramatically before you jump in. These take time. Patience is key.
And the final category, number 6, asset plays. The hidden value stocks.
6, asset plays.
Right.
These are companies where the value isn't obvious from their current earnings. It's hidden on the balance sheet. Maybe they own incredibly valuable real estate that's undervalued on the books.
Or tons of cash.
Or maybe patents, broadcast licenses, even natural resources like gravel pits, as Lynch famously found with Pebble Beach. Wall Street might ignore it because they're just focused on next quarter's earnings.
How do you even find these if they're hidden?
You got to dig deeper. Read the footnotes in the annual report, the 10K filings. Look beyond the income statement to the actual assets the company holds. The values in the stuff they own, sometimes more than the business they're currently running.
Okay, we've got the categories. Now, how do we value these stocks once we've classified them? Lynch used the PE ratio a lot.
The price-to-earnings ratio, it was his go-to shortcut. It basically tells you how many years of the company's current earnings it would take to pay back your investment.
And he had that simple rule of thumb relating PE to growth rate.
Yeah, the PEG ratio idea, essentially. A fairly priced company, he said, should have a PE ratio roughly equal to its annual earnings growth rate.
Give us an example.
Sure. If a company is growing its profits at, say, 15% per year, then a PE ratio of 15 would suggest it's reasonably valued. If the PE is 30, twice the growth rate, it looks expensive. If the PE is only 8, it might be cheap.
Simple guideline.
It's a starting point. You also have to factor in dividends, but it gives you a quick check. Am I paying too much for the growth I expect?
Beyond PE, what else on the balance sheet did he absolutely insist we check? Debt, you mentioned.
Debt is huge. Check the debt-to-equity ratio. How much debt does the company have compared to its net worth? Less debt is almost always better, especially for fast growers or cyclicals. As Lynch said, no one ever went bankrupt without any debt.
Good point. Any positive signs to look for on the balance sheet?
Share buybacks. If a company is consistently buying back its own stock, that's usually a great sign. It reduces the number of shares out there, which automatically increases earnings per share for the remaining shareholders like you. It shows management thinks the stock is cheap.
And on the flip side, a big red flag. Inventory.
Inventory buildup. Watch out if a company's inventory is growing faster than its sales. That's a classic warning sign.
Why that's so bad?
It means they're making stuff faster than they can sell it. Demand might be weakening. That often leads to price cuts, lower profits, or having to write off unsold goods, especially in tech or fashion where things go out of date fast. It can be the first sign a fast grower is slowing down.
Now, Lynch had a really controversial take on diversification, said he didn't believe in it. That flies in the face of standard advice.
Yeah, his quote is jarring. I don't believe in diversification at all. I would own one stock if I could find one great stock. But you gotta understand the context.
He wasn't saying put all your eggs in literally one basket.
Yeah, no. He was railing against what he called diversification. Buying a bunch of stocks you know absolutely nothing about just to feel diversified. That, he thought, was pointless or even harmful.
So if you do the work and find, say, 10 genuinely great companies you understand,
Then buy all 10. That is diversification. But his key was active management. You don't just buy and forget. You constantly reevaluate.
with a rotation idea.
Exactly. You're always comparing. Is the story for company A still better than the story for company B? If B starts to falter, maybe debt is creeping up or growth is slowing, then you sell B and put more money into A or into a new great idea, C. It's about concentrating on your best, well-researched ideas.
Okay, final section. Avoiding the pitfalls. Lynch listed these dangerous things investors say, usually driven by emotion, right?
Almost always emotion or ego, and they lead to terrible decisions. Let's start with maybe the most common one for people holding a losing stock.
It's gone down this much, it can't go lower.
Yeah, that's magical thinking. It implies the stock somehow knows how much it's already fallen or what you paid for it. It doesn't.
His Polaroid example is brutal.
Painful. It fell from $140 to $107. People thought, okay, under $100 is a safe buy. It blew past $100 and just kept cratering, down to $18. The stock doesn't care about past prices. It cares about current business reality. If the business is collapsing, the stock price can go much lower, even to zero. He mentioned Kaiser Industries doing the same to him.
And the flip side, thinking cheap stocks are safe. The $3 stock illusion.
Hey, it's only $3. How much can I lose? Well, you can lose $3,
Wow.
100%. A bad company is a bad company, whether the stock costs $3 or $50. The percentage risk is the same. Don't waste time on junk just because the price per share looks low.
Then there's the false optimism. It's always darkest before the dawn. Trying to justify holding on.
Lynch had a great comeback. Sometimes it's always darkest before pitch black. You have to distinguish between a temporary downturn and a business or industry that's fundamentally broken and just going to keep getting worse. Hope isn't a strategy. You need actual evidence things are turning around, not just wishful thinking.
And the ego trap. I'll sell when it gets back to what I paid for it.
Oh, that's a killer. When I rebound to 10, I'll sell. The stock has no idea you own it or what your break-even point is. It's completely irrelevant to whether it's a good investment today. Sell because the company's outlook has soured or because you found something better. Don't hold a loser just to avoid admitting a mistake.
What about those really speculative bets? The whisper stocks?
Avoid them like the plague. These are the stocks with amazing stories going to cure cancer, solve the energy crisis, but they have zero sales, zero profits, pure hype.
Lynch said he tried them.
Tried 30 of them himself, he admitted, and never broke even on a single one. He called them no shots, not long shots. Steer clear.
And also avoid chasing the next big thing.
Yeah, the next IBM, the next McDonald's. Imitators rarely succeed like the original. And jumping into whatever industry is hot right now, disk drives back then, maybe something else today usually ends badly. By the time everyone knows it's hot, it's probably overcrowded and headed for a fall.
So after all the analysis, the categories, the warnings, it comes down to psychology. Lynch said the stomach is more important than the brain.
Temperament is everything. Can you handle the emotional roller coaster? Can you stick with your research and your plan when the market is panicking or your stock drops 25%?
If the story hasn't changed.
If the fundamental reasons you bought the stock are still intact, good earnings, low debt, strong execution, then a price drop is noise. It might even be a chance to buy more at a discount. But if you know you're going to panic sell at the first sign of trouble, maybe individual stock picking isn't for you. You need that intestinal fortitude.
Focus on the company. Use the framework. Manage your emotions. That's the Lynch way.
Pretty much. And remember his point about the individual's edge. Professionals are often stuck with rules. They can't buy small companies. They worry about looking wrong in the short term. You, doing homework on businesses you actually understand, can often beat them.
Which brings us to a final thought, something for you listening to consider, applying Lynch's ideas today. He noted later on that the market itself has changed. Fewer public companies now.
Yeah, dramatically fewer, down from maybe 8,000 to closer to 3,000 public companies in the U.S., and a big reason is private equity.
How does that affect the Lynch strategy?
Well, Lynch worried that these private equity firms are now snapping up the promising small companies, the potential 10-baggers, much earlier in their life cycle. They buy them out, take them private, often at just 2x or 3x the initial price.
So the individual investor might not get the chance to ride them all the way up anymore.
Exactly. The best growth stories might get pulled from the public market before they deliver those massive long-term Lynch-style returns. So the question for you is, if those great small companies you find get taken private early, how do you adapt? How do you capture that growth value in today's market? Something to chew on.
A really interesting challenge for the self-directed investor today.
Definitely a critical question.
Well, this has been fantastic, really digging into the practical wisdom of Peter Lynch. Thanks for breaking it all down.
My pleasure. Timeless stuff.
Absolutely. We'll catch you next time for another deep dive.